So again, I believe we're in a great period right here. The other scenario that we model, just so we have something to compare it to, and there is precedence for this in the world, is Japan. So Japan has been here at this point for the last 20 years. And they don't know how to figure out how to get out of it. Now, the Japanese economy was at one time the second largest economy in the world. It's in the top 5 even today, but they can't figure out how to get out of this moribund situation that they're in. I believe the United States has greater diversification and just the will and the innovation that's here in the United States will take us out of this location that we sit at today. And I actually think we're seeing dramatic signs of that already. Apple Computer is a great example. Look at some of the businesses. I would have said Google, notwithstanding yesterday's news. Just a little oops there. But clearly look at the innovation that comes out of the United States. And you will see very, very quickly that the United States can clearly overcome any difficulty. I'm a big study of World War II, and actually that coincides with one of these other interest rate spikes in our history. And this country knows how to fix itself. And it's interesting, I forget how many recessions we've had since the founding of the nation. Every single one has been followed by a recovery. So I don't expect that this will be any different, yes.
I think we're in an interesting conundrum in terms of interest rates. Blank, Fine, Simpson, Bowles were on TV the other day talking about balanced budgets. He said something very interesting. If we normalize interest rates, whatever that means, it would like triple the debt of the country, because of course the interest rates we're paying now are so low. So to the extent it recovers and the interest rates are low or whatever, it's going to blow away the whole budget deficit.
There's a real conflict of interest here, isn't there?
Yeah.
So the Bank of the United States is setting interest rates, and it's the largest borrower in the world. Where do you think their motives are?
Well, and then a corollary, if I may say, a corollary to that is we have 10,000 people retiring every day. Okay? They're turning 65 or whatever. I assume not all of them are in the market. I mean, you see them with their CDs, etc. And basically,
they're getting crushed.
There's no adjusted return, adjusted inflation, adjusted return.
They're getting crushed, but on the flip side, the home that they own, is costing them a third of what it cost them, even 4 years ago. So there's trade-offs, and the Fed has come out and said that the people that they really feel the worst about are savers, seniors and savers, who are getting no interest rate, right? A 6-month CD today is paying what? I don't even know, 0.2 or something? It's ridiculous. Yes?
Could you just speak to the student loan debt and how it impacts your whole presentation?
Well, the student loan debt really is sort of it's a tempest in a teapot, sort of, from a interest rate environment scenario. The government came out, I think it was about a year ago, nationalized the student loan business. So what was happening is the U.S. government was guaranteeing student loans. And then they gave it out to private banks. We could have done student loans, and you would get to buy a guarantee from the U.S. government. So you'd come to me for a student loan, we'd make the loan, government guaranteed it, government would allow us to borrow at, near zero, and I'm charging you 14%. So the government said, why are we doing this? Why don't we just make the loan directly? Since we're providing a guarantee, we'll make the loan directly. And so that's the scenario we find ourselves in today, and they dramatically drove down the rates on those loans. Do I think that that's something government should be doing? We just talked about the fact that we don't have enough people being trained in the right places, doing the right things. I mean, I think it is a business the government should be in. I don't know of any other entity that can actually provide, because think about what a student loan is. It's a subprime loan. You're lending money to somebody who has no ability to pay you back. That's not the business we're in. I have this funny thing, maybe it's my Italian heritage, we lend money back, lend money out, we want to get paid back by any means possible. So, but when you look at a student has no job, has no financial history, has no collateral, doesn't have any of the things that a bank should look at to make a loan. And so I think there needs to be a significant role played by government if we feel that that's something that we should be doing. I don't know, United States, greatest country in the world, we should have people going to college, and we should be able to provide for that. I don't think that's, I forget, the whole budget for the student loan thing is in, I don't know, $5, $6, $7 billion. It's like meaningless in a $2 trillion budget.
I mean, in some ways, it's a major problem because I know many people who have lots of loans who don't have a job and can't live.
Well, that's
There's no way to mitigate the interest rate that the government set.
well, the government guaranteed student loans. There has been, and those loans are at a very low interest rate. They're in the 3% range. It's the non-government. If someone took a private loan, where the interest rates could be very, very high, and actually. And again, I'm not an expert here, but I know there are other components of the student loan where Congress wouldn't pass certain legislation to allow for them to be not bankruptcy remote anymore. And there's a very complicated set of dynamics there. Some of it's political, but at the end of the day, I get why we make student loans. They should be at a very low interest rate, and they should be available to just about anyone.
I have two questions. One, you talked about the too big to fail. Why don't they just undo GlassSteagall? It shrinks the balance sheet of all these too big to fail banks, and it takes the riskiest activity away from the banks, which will effectively lower the.
Who in the room knows what GlassSteagall was? Okay, so GlassSteagall was a law that was enacted immediately after the Great Depression, and it separated investment banks in its simplest form. It separated investment banks from commercial banks. So if you took in deposits from ordinary people or businesses, you were prohibited from doing investment banking. And so the interesting thing about GlassSteagall is if we look at the failures that occurred in 2008, so if we look at Bear Stearns, if we look at Lehman Brothers, if we look at AIG, if we look at all the failures that occurred, none of them were GlassSteagall violators. None of them were commercial banks.
But if you get activity out of the banks, you could let that activity fail.
Okay, so there's a law, or part of the Dodd-Frank legislation, which is called the Volcker Act, which prohibits banks from trading on their own accounts. That has not been implemented yet. I think it will be implemented. I think they will find a way to get that done. And in effect, that will stop banks, not from providing investment services, but from trading for their own account, which is the riskiest of behaviors. And I think that, in combination with the Basel III higher capital standard, will actually start to force some of the largest institutions to think about selling off parts of their businesses, and actually may bring the size of those institutions down. Yes?
How are the difficulties that municipalities are facing affecting your current scenario? Or are they not?
Not us directly. Clearly don't like to see municipality fail and have a debt burden, on other banks or investments.
But that's not affecting the scenario well.
Not at this. I mean, there's a much bigger political question that needs to be answered as it relates to municipalities and even states, right? I don't know, 30 some odd states are technically bankrupt. So what role does the federal government play? And as the federal government continues to push everything off to the states, what does that mean to you and I? We don't want to hear about the federal deficit, but we're okay with our state running, these incredible deficits, or even our municipalities running, home rule. Look at Bergen County. We got, I don't know how many police chiefs, making $220,000 a year. As I was saying about the banks, I think the whole form of government, from the top down, has to be rethought. We're going to have to be more efficient. The great thing about the world we live in is we have all this technology. There's things that we can do today to be more efficient. You can do it in your business. We're going to have to do it in government too. We don't need all the services and things. I mean, in my town, where if you read the newspapers, I live in one of the towns where we have one of those red light cameras. And I've gotten 2 red light tickets already, right? So, but you go online and you bring up the ticket and they show you a copy of your license plate number, and you see a shadow that looks like you in the car, and you go, yeah, that was me. And you pay it, right? You pay it online.
What are you going to argue with
Well, when I got a parking ticket 3 years ago in town, I had to go to the borough hall and go say hello to the court clerk, write out a check. She gave me the bill, had to file it, stamp it, put it somewhere. Well, that's not happening anymore. So why is that person still why do we have as many of those people still doing the same thing? Technology has changed. Most people pay their taxes online. I mean, this is prevalent through the entire economy. And so one of the things that I would also tell you is, don't be overly concerned with this 7.8% unemployment rate. I'm not convinced we're ever going to get to unemployment rates of 4% or 4.5%, which used to be full employment. I don't think that's ever going to happen again. And I think there is going to be a shift in what that really means in this economy.
Already has, all shifting to India and everything, global.
Well, outsourcing technology, what did I just tell you? I just told you that, from the banking perspective, we're not going to open as many branches. You'll see banks closing branches. So we're going to do more with less people. So, yeah.
On that topic, banks were,
Bob, am I okay with time, or you want me to stop? Last question? One more?
banks were outrageous in their expansion. So they added to the real estate economy, they added to the construction economy, they added to all of these accessorial services that were needed to build these banks.
Yep.
Now all of a sudden they're gonna close them. That's gonna kill, quote unquote, local real estate markets. Now, I live in Bryan, New York, and there are 11 banks within 3/4 of a mile on Main Street in Bryan. Half of those banks are empty half the time. It was an absolute ridiculous choice to build these branches.
That problem will self-fix itself. As I said, branches are in a serious decline, and I think you're going to see less and less banks.
But it's gonna hurt the local real estate.
It might. It might. Yes.
If we see less branches, do you see a scenario where there are gonna be like kiosks, like ATM kiosks? I haven't really seen those around.
Different banks are using different strategies for dealing with, the new technology and dealing with their clients. So some banks are doing exactly that. Some banks have gone to this super glorified ATM machine.
Right.
Other banks are actually doing remote teller applications where you're going to go into a very, very small space, and instead of having live tellers, you'll go to a machine that'll give you a video feed to someone in a back office, maybe in India, I don't know, to handle your transaction. So different banks are going to handle that technology differently. But yes, you will see different attempts at that until something works. Yeah, there'll be a disruption in the marketplace.
Do you see a change in the business model from the credit cards that you're basically, the small businesses are paying? It's a new, Square device where it's by transaction. Is that going to be more of a growth?
Yeah, I think you're going to see over the next couple of years an incredible disruption in how we use technology for payment services. And so if you think about a credit card is basically a piece of plastic with a piece of 8-track tape stuck on the back of it with some information on it. So it's 40-year-old technology, and we still use it here today. And there are other parts of the world where they have a chip embedded in the card, or where I think technology is going and where we're looking to make investments today is, it'll be on your cell phone. All your information will be available, and authenticated to your own personal device. And you'll be able to select how, the methodology for making the payment, and you'll be able to push a button and make that payment, and everything will be authenticated and
It's still with
payment
a
made.
monthly fee and then a transaction fee on top of that.
Well, that's going to depend on the institution, right? So, and it's going to depend on the entrance because everyone wants to get in the business, right? Apple wants to play a role, Google wants to play a role, the banks want to play a role. So that's going to be an interesting dynamic to watch play out. Anybody else?
All right, one question. Tell us about the future of the bank, where your vision is over the next 3 to 5 years in terms of technology and all the other things.
So we're one of the few banks in the country that have really taken also a barbell approach to our business. We call ourselves a community bank, but and so what that means is, we're really good at shaking hands, hugging people, kissing babies, all that good stuff that most community bankers are good at. But the other side of the story for us is we've spent an enormous amount of money investing in technology that actually allows us to play in some of the same fields that some of the largest institutions play in. So there's very few services that we can't provide at our institution. And so that sort of differentiates us from most of the other community banks. It's one of the reasons why we're the 5th best performing bank in the country, not just because we're so good at technology, because that technology has made us very, very efficient. So we're nearly $1 billion in size here as we sit here today. Most billion-dollar banks have 14 branch locations, we have 8. So we have basically half the infrastructure from a people perspective, and we've made up for that in technology. So to answer your question, the future to me looks like we're going to continue to invest in that technology. We will still open other physical locations in other places. They will be more remote, and we will invest heavily in technology and in people. So we'll be looking to make investments in people that can bring the business on board, as opposed to having the greatest, best, downtown location on the best corner. So that's where we're going.
I just want to speak to that for 1 minute.
Yes.
Because I'm from Long Island.
Yes.
And Valley just went to Long Island.
Yes.
And I was banking in a small community bank.
Yes.
And now I have Valley.
Yes.
They have not invested in technology.
Yes.
Second
They are
that.
one of the gifts that keep on giving.
They're good at acquiring things, but not really taking care of them.
Yeah. Actually, and that brings up an interesting point. I mean, last year when we did our plan for the business, we looked at the largest 12 or so client relationships that we brought on board, and over 6 or 7 of them had nothing to do with our geographical location. They were actually outside the geography of the bank. One of them actually was in Long Island. We do a fair amount of business in New York City. We do a fair amount of business in other counties where we have no physical presence. And so all I would tell you is that the nature of the business is changing dramatically, and you don't have to bank with a bank that has a branch on your street corner anymore. So.
One more thing.
Okay.
You mentioned early on that the capital reserve requirements were going to be equal across the board, regardless of the big banks, and the mid-sized, and the community regional banks. Do you feel that puts those smaller community banks at a disadvantage because you have the same capital reserve requirements?
I think it does. And we'll figure out a way to deal with that. But if the law's enacted the way it's written today, and I don't believe it will be, but if it was, we'd have to have the same capital requirement as Citibank.
With much deeper pockets.
No, it's not the deeper pockets. It's the ability to raise capital. So they can go to Wall Street and raise the capital. We can't. And so I think it's going to sculpt behavior. I think it's going to force efficiencies. I think it's going to do lots of things. Some of them will be good. Some of them will not be so good. And if we were to go back through this timeline and look at the history of banking and clearly look at points forward from the Great Depression, because that's when the safety net was built into the banking system. So the banking system in our country looked vastly different prior to the Depression than it does today. It was Depression era that created the FDIC and all these other safety nets that exist in the banking arena. You would find that community banks, for the most part, operated at about a 6% leverage ratio for almost their entire history. And for the most part, never really caused anybody any worry at 6%. We're being forced now to drive capital leverage ratios to 8.5% and 9%. So for every dollar that we have, or every $100, let's make it simple, that we have an asset. So if you make a $100 deposit and I make you a $100 loan, that's $100 in assets at the bank. I have to have, currently, under the new standard, $9 in capital. So that capital only comes from 2 places. I either earn it and it's retained earnings, or I raise money from my investors. But I have to have $9 of those 100 as capital in the bank. Well, if I have to have 9, my leverage rate, I can only make a certain amount of loans. I can only lever that $9 10 times. If it was 6, I can lever it 14 times. So I can make 40% more loans by driving the leverage ratio down to 6%. And for the last 50 or 60 years, banks have been operating in the 6 to 7% leverage ratio. And now the standard is going to be closer to 9. And the regulators are also coming into banking institutions and saying, well, the standard's 9, you should really be holding 10. So, and that's my concern is there's an enormous, we calculated it at our bank, in the entire country, it's about $2 trillion worth of lending that's being pulled out of the system. It's a $14 trillion economy, $2 trillion worth of lending is not being allowed to take place because of this constraint. So.
Any other questions?